For literally thousands of years, gold has meant one thing: security, wealth, power. But in today's crazy financial world, what is it really? Is it that safe harbor you run to when things get chaotic? Or is it just another high stakes gamble? Okay, let's really get into this, because we're about to look at two completely different sides of gold. For centuries, this right here has been the common wisdom. The idea that, when paper money starts to look shaky or the markets are in a panic, gold is the one thing that will hold its value. It's an idea it's baked into our financial DNA. And what's so fascinating is that this isn't just some old story. The biggest, most powerful financial players in the world, we're talking central banks, they still stockpile gold for these exact reasons. They see it as a shield against inflation, a universal currency, and this last one is absolutely key. It carries no credit risk. It's not an IOU from someone else. It's the real deal. But what happens when that core belief, that idea of perfect safety, gets absolutely rocked? Well, this whole concept was put to the test during one absolutely insane 48-hour period back in January of 2026. Just look at this timeline. The market went on a complete roller coaster, from total euphoria to sheer panic in less than 2 days. On Thursday, everyone was piling into gold, pushing it to a record high. But by Friday morning, a single rumor about who might run the U.S. central bank sent prices into an absolute nosedive. So on that Thursday, prices just skyrocketed. I mean, a jump of over 12,000 rupees for just 10 grams of gold in one day. It created this total frenzy, and it seemed to prove the whole safe haven story. It looked like the perfect asset. But then, just as fast, the market slammed on the brakes and went into reverse. An almost 9% drop in one day. That's a huge, huge move for any asset, let alone the one that's supposed to be the definition of stable. All those record gains, a massive chunk of them just vanished in a few hours. And this really shows you the risk, because it wasn't just gold. Silver got hit even harder, crashing an unbelievable 17%. The whole precious metals market was in chaos, and it wasn't being driven by long-term value. It was all about short-term news and gut reactions. So this leads us to the big puzzle, right? We just saw gold act like a ridiculously speculative bet. So why on earth would these super cautious, stability-obsessed institutions, why would they hold so much of an asset that can swing around like that? Okay, to figure this out, you have to look at these two trends side by side. On one hand, you see gold's role kind of goes up and down. But on the other hand, you see this steady climb in central banks acting independently, making decisions based on data, not politics. The answer to our puzzle is right there, where those two lines meet. And luckily for us, we don't have to guess. A really detailed study from Charles University dug into this exact question. They crunched the numbers to see if gold actually does what it's supposed to do for the institutions that hold it. All right, before we get to the juicy stuff, we have to understand this one key idea: inflation targeting. It's basically a modern strategy where a central bank says out loud, our goal is to keep price increases at, say, 2%, and then they use all their tools to hit that target. This whole framework, it turns out to be crucial. Okay, so here's where it gets really interesting. The researchers looked at 110 countries, and at first, they found nothing. No real proof that holding more gold meant less inflation. But then, they separated out just the countries that were using that inflation targeting strategy. And boom, a super clear link showed up. For that specific group, gold actually worked. And this is the big takeaway from the research. Gold's stabilizing power isn't some kind of magic trick. It's not universal. It only works its magic when it's part of a very specific, disciplined, and public economic strategy. The policy around the gold is what matters. So now we have to put these two pieces together. We've got the story of that wild, chaotic market, and we have this academic proof that gold can be a stabilizer. So how do we make sense of these two very different realities? It turns out the reality is just a lot more complicated than the simple myth. For an everyday person caught up in the news cycle, gold can be a seriously risky gamble. But for a central bank that has a clear public plan for inflation, it can be a really powerful tool for long-term stability. It really does have two completely different faces. So, why should you care about any of this? Because it completely changes how we should think about gold. It's not some simple, guaranteed safety net. Its power as a stabilizer is only unlocked under very specific conditions. It's not a magic wand, it's one complex tool in a very big toolbox for managing an economy. And that leaves us with this final question. Is gold just an old relic we can't let go of, or is it the ultimate insurance policy for whatever economic craziness is coming next? And the answer, it seems, is that it's probably a little bit of both. And that's exactly what makes it one of the most argued about and honestly one of the most fascinating assets on the planet.